Hey everyone, Albert Liu here, inviting you to join us at the first ever Rural Silver Investors Bootcamp for an exclusive lineup of silver mining CEOs, traders, analysts, and other expert speakers. This online event, which takes place on February 11th, is geared towards silver investors and speculators of all levels. More details at rulesymposium.com/bootcamp. Welcome everyone, and Happy New Year, and Happy New Year to you, Rick. How are you?
Albert, I'm doing very well, thank you. And thanks again for making this series occur.
It's a labor of love for me, and I'm all recharged for the new year, Rick. So let's get started with some great content. Not our favorite topic probably, but one that is extremely important personally and as an investor speculator, and that is tax considerations when speculating in mining companies. So why don't you set us up, Rick? Why is this so important, and why should the listener or the viewer really pay attention to this episode?
Well, Albert, I think your scheduling was genius, having a tax conversation at year end. If ever there was advanced clickbait title, tax probably covers it. In fact, today's session won't talk so much about individual tax considerations, but rather we'll talk about the impact of direct and indirect taxes on mining companies and how understanding some of the big points around taxation will make individual investors better at securities analysis.
Okay, this is a very popular topic for financial advisors in the new year because they know people are thinking about it, but it's actually a coincidence. If I was going to engineer a topic, it would have been tax considerations and strategies for weight loss in the new year, because those are the two big search items at the beginning of the year. Okay, so Rick, take it away.
Well, I want to start by talking about the odd fact that most financial analysts and most investors who pay attention to securities analysis do so on a pre-tax basis. Most of the popular documents around net present value calculations occur pre-tax. The only reason that I can think of for this to occur is that pre-tax net present value numbers are higher than post-tax net present value numbers, and most of the analysis that is published around mining industry securities are published by investment banks, wealth managers, and asset managers who have at least an indirect incentive in making the numbers look better than they otherwise would. The truth is that neither companies nor investors get to spend pre-tax dollars for the most part. They spend after-tax dollars. And so I want at the beginning of this discussion, Albert, to simply have people understand that every aspect of financial analysis in mining, and for that matter, probably all investments, needs to be done on an after-tax basis and needs to take into account direct and indirect taxation. Yes, everything else that we've talked about in this series thus far, a practiced, successful, focused management team, high-quality deposit, an understanding of an engineering, an understanding of geology, an understanding of the capital stack, an understanding of access to capital. All that is important, but tax is important too. If most investors listening to this program, Albert, considered the fact that on their own budget, the money that they spend directly in tax is as a percentage of household income greater than food, greater than energy, greater than transportation, and greater than shelter combined. It's interesting that people seem to assume, and I guess they should, that taxes are inevitable. And perhaps because tax is such an unpleasant topic, people choose to avoid it. But avoiding tax in securities analysis is akin to committing suicide in terms of financial analysis. Let's start with the three documents that we have described earlier in these series as being critical for examining advanced stage exploration companies, development companies, and producing companies. These are, respectively, the preliminary economic assessment, that is, the document that attempts to develop a very preliminary economic target size and a very preliminary sense of what a deposit might be worth, assuming that certain assumptions come true. The second document is the pre-feasibility study, which is a document that is a much greater refinement of the preliminary economic assessment, but still not a document that is designed to give a really sort of binding sense of what processes might be used, what the capital costs, and what the operating costs might be. And then there's the granddaddy, the feasibility study, or the bankable feasibility study. This is a document that companies use to obtain both debt and equity finance, and increasingly other forms of finance. People who are interested in other forms of finance should refer to our discussion about the capital stack, a great interview, which I think you just posted. But the feasibility study is the bedrock document for understanding, in a financial sense, what a deposit is worth, what processes will be used, what the capital costs will be, what the operating costs might be. Understand that there are some variables in all of these documents. One variable, of course, is the commodity price. A preliminary economic assessment attempts to be a view of a deposit that's a snapshot in time. Understanding that the deposit might not be developed for 10 years or 15 years. And so the time value of money becomes important. Commodity prices become important. And as we will talk about, differently than the time value of money, input inflation will be important too. And as we proceed through a study of increasingly accurate documents up to the feasibility study, the time value of money considerations, the inflation considerations, all of those considerations become less important. What is important to remember for this discussion is that the most oft forgotten input, or perhaps I should say the most important reduction in output, is tax. If you are reviewing a document that has a net present value associated with it, or a document that has operating cash flow numbers associated with it, and those numbers don't take into account tax, understand that the number that you have is an interesting number, but from an investment point of view, it is almost a useless number. It can be useful for very sophisticated financial analysts who could talk about the net present value of a deposit were it acquired by a company who had, for instance, tax loss carryforwards, or if there was some means of sheltering the tax. But it is not useful in terms of calculating, from my point of view, the true economic value of the deposit. For the true economic value of the deposit, the calculations must be made after tax. Note, too, that these calculations will never be completely accurate for the simple reason that taxes change. They seldom go down, they mostly go up. But one can only assume that the after-tax net present value number and after-tax cash flow numbers are baseline numbers to understand the impact of taxation. When you look at a properly done preliminary economic assessment, a properly done pre-feasibility study, and particularly a properly done bankable feasibility study, what you will see in the assumptions period, in the assumptions table, will be both a pre-tax and an after-tax calculation of cash flows and net present value. One may simply look at the delta between the pre-tax net present value and the after-tax net present value to get a sense from one's own perspective about why this number is important. Remember again that companies cannot dividend out pre-tax income. they have to pay tax on it. Similarly, with some exceptions, companies can't reinvest pre-tax income. There are some exceptions to that. We could talk about them some other time. But it's important to note that when you are doing securities analysis, economic analysis on mining companies, that you need to do it after tax. Let's review some fundamentals, Albert, that we talked about earlier. One calculation that you're doing in any advanced company or producing company is the net present value of future cash flows plus any terminal value that might be associated with property, plant, and equipment, and equity and land. That is to say, what the deposit is worth, as opposed to the enterprise value, which is the market capitalization of the company plus redundant assets that they might have minus debt. The value proposition, the most basic value proposition in securities analysis, is simply the juxtaposition between net present value and enterprise value. And a net present value calculated pre-tax is fiction, simply fiction. Remember, as I said, that the net present value calculated after tax can be fiction too, because tax rates can change and variables can change. Once one has calculated, as we've described in earlier interviews, the ratio as best one can between net present value and enterprise value, what you need to consider is the ability of the company to utilize that free cash flow in some way that might be beneficial to its owners. That is, you need to look at the cost of capital, both debt and equity, versus the return on capital employed. Doing this on a pre-tax basis is useless. You need to, as we've discussed in earlier interviews, look at the return on capital employed versus the return on equity, which is simply to say, if the company employs a more exotic financial stack or a financial stack that includes debt, what is the interest payable on the debt relative to the return on capital employed? Because the delta reports to equity, return on equity. And then, of course, one needs to look at the recycle ratio, which is to say the ability in the company's pipeline within the capabilities of the management team to redeploy that free cash flow to grow the company or else return surplus cash to shareholders. It is critical, Albert, in each of these calculations to include a number that is an after-tax calculation, because that is the true free cash flow. While we're talking about the impact of tax on securities analysis, and by the way, feel free to interrupt me at any point in time if you think I've glossed over something that needs to be explored more deeply. But while we're on the topic of tax, I think we need to talk about both direct and indirect tax, which is to say there are corporate income taxes, there are royalties, there are a whole bunch of ways that social rents get extracted from extractive industries. But there are also an increasing number of indirect social rents that need to be considered. These are often found in the aforementioned documents, the PEA, the PFS, and the FS. They might include contributions in lieu. It is common, as an example, in developed nations in the West for, and around the world actually, for companies to be asked to contribute in some fashion as a way to ameliorate their supposed or actual harm. That might be, as an example, that companies are asked to do environmental remediation off-site, which is to say, improve some other piece of land as habitat as compensation for the obvious surface destruction that will occur as a consequence of mining. It is very common in developing countries and in emerging markets for companies to be asked to or forced to make contributions to infrastructure, as an example. a mine which is being built in a very remote location in eastern Congo, I'm thinking about Alphamin specifically, by necessity was forced to build a 60-kilometer road because they were building a modern mine in a roadless area. In addition to that, they were asked to, but in fact had to, upgrade the main road because the main road wouldn't accept the haul trucks that were necessary to move their material to market. It is common that mining companies are asked to provide educational facilities, power and electrical infrastructure, fresh water, sanitation, housing, and environmental considerations. These are all indirect ways of extracting social rent. You will find in the preliminary economic assessment, the pre-feasibility study, and the feasibility study very often discussions of the direct social take, which is to say any carried interest that the host government might have in the project, or any royalties which might accrue to the host government in the project. It is important when one looks at the valuation documents associated with the project to understand if the calculation is done in effect on an 8/8 basis, which is to say, does the free cash flow calculation and the net present value calculation describe the project at a project level, or does it in fact flow through to the investor? Let's say, as an example, that a feasibility study exists on a project and it has a project net present value, that is to say, an 8/8 project investment. And the project is valued at $1 billion US. If it is a project level feasibility study, and the state has a 20% carried interest, please understand that only 80% at best of the net present value of the project net present value will accrue to the company, and hence indirectly to the investor. One needs to look too at what the ongoing obligations are with regards to the issuer, to the state, or to society, and see how those are included, if they are, in the feasibility study. It's important too to understand what the incipient environmental liabilities are, what the reclamation liabilities are, and what might be regarded as terminal value, which is to say the ultimate value for scrap of the property, plant, and equipment, or the ultimate value associated with equity interest in land and real estate, if any, at closure. All of these things, all of this direct and indirect government take are at once inevitable and very seldom understood by investors. It is a truism, too, during periods of increasing commodity prices that one factors in net present values. One needs to understand that as at least the nominal values of commodities increase, the pressure from voters through the government to increase the net present value of the state and society's take increases. From my point of view, I try to look to the best extent that I can, and understand that I never get it right, nor does anybody else. But I try to look at societies where the demand for social take is increasing. As an example, for the last 40 years, the best mining jurisdiction in the world, from my point of view, has been Chile. There are now extraordinary social and political pressures to increase the take of the state in direct and indirect ways in the mining industry. It is likely, although by no means certain, that the state will find ways to increase the direct and indirect proportion of the free cash flow or the net present value of a deposit. So understand that even calculating the after-tax internal rate of return one probably needs to discount that number given the fact that there are increasing social pressures for a greater state take in mining.
So, Rick, just a question, if I may, about the tax issue, and you'll have to forgive me again for appearing to reduce the discussion and strip it of nuance. But I want to know if you have how you incorporate tax regime into the initial screen of companies, and how often do tax factors become the pivotal factor in whether or not you look further into an opportunity. I want to know how early in the screening process this comes up.
Well, quite early. I have a sort of a blank cutoff, which is to say that I require a 20% return on capital employed after tax. Usually, a responsible document will have a pre-tax calculation and an after-tax calculation. And usually, a responsible document will take into account the individual tax rate in the country concerned. It's important to note that you have to modify this based on your own perspective with regards to what future tax considerations in that country will be. Remember that you're never going to get this right, that this is only a guideline. I moderate the acceptance in my own mind of a 20% return on capital employed by overlaying the cost of capital in that country, what their sovereign rate is in US dollars. So as an example, a deposit in Western Australia could be right at 20% because the Australian government's US dollar sovereign borrowing cost is fairly low, compared to, as an example, a deposit that was in Iraq, Congo, or Cambodia, where the costs of capital associated with the deposit will be much higher. I realize that cost of capital calculations are usually included in the documents that I've talked about, but I have found astonishing variability in the assumptions used in terms of the cost of capital. So for me, if I have a 20% ROCE, return on capital employed cutoff, on an after-tax basis, whether or not that number is acceptable depends for me on what I think the real cost of capital will be.
And then regarding the different forms of taxation, you mentioned, social rents and whatnot. How do we prefer to be taxed? It seems like being taxed in the form of, I know it sounds like a ludicrous question, but taxes that come in the form of, for instance, building infrastructure, providing educational resources, should be seen as a welcomed thing to the host company, and so often politicians, as they do here, have a tendency of taxing and then not spending on behalf of the people. So is there a preference for having for being taxed in that sort of way that is a sort of a visible direct benefit to the population?
My own preference, as you say, is for expenditure in lieu, which is to say direct contribution by the mining company in the form of infrastructure or community benefit. There is a joke in mining around the world, particularly in developing markets, but also in developed markets, where the social rents from mining accrue to the capital, but the regions where mining occurs bears the costs. Or put less eloquently, the capital gets the mine and the region gets the shaft. So expenditures that benefit the local community and expenditures that are made in infrastructure, which is necessary for human resource development and actual resource development, and taxes that accrue and are used locally rather than regionally or federally, are almost always, from the shareholder's point of view, superior. We're going to get into some nuances as a consequence of that question, which is to, and most investors, myself included, won't in every circumstance have the political and social sophistication to understand the correct balance of taxation. But even in deposits where there are substantial local benefits, there need to be some regional benefits too, because adjacent municipalities will come to resent the municipality closest to the mine, which enjoys the most benefit. So the truth is that the mining companies need to learn to spread the largesse and benefit as many people, and to be seen to benefit as many people as is possible. One of the things that I'm enjoying seeing right now, Albert, is popular protests in emerging and frontier markets in favor of mining by local communities who regard the anti-mining stance of regional or federal entities as being an infringement on local development. And I've been heartened, in the last 6 months to see increasing popular support at the local level for mining, really around the world, as a consequence of mining companies becoming better at engaging local people and becoming better at providing tangible benefits, not just employment benefits, to the communities that they serve. But Albert, I want to return to the topic of taxation and talk about a real pernicious form of indirect tax, which is to say inflation. It's my belief that much of inflation is in fact a tax. When a central government debases a currency, and the consequence of that is that more specious currency units chase fewer goods, what you have is inflation, which is really a tax. I saw a recent estimate which would suggest that over the last 2 decades, that operating costs, input costs, not capital costs, but operating and input costs over 20 years in mining have increased at 7% compounded. When you are looking at a valuation document, any of the documents that I've listed above, particularly one with very long lead times, like a preliminary economic assessment, understand the impact of inflation. Understand that for the last 5 years, as an example, capital input costs, which is to say steel, cement, fuel, skilled labor in construction, have been increasing at a number closer to 20%, while input costs, which is to say long-term labor costs, long-term energy costs, long-term transportation costs, have been increasing at 7% compounded. So if you're drawing a net present value number from a preliminary economic assessment where you assume that the mine won't be built for 10 years, look very closely at the inflation projections in the document and think about the fact that over 20 years of fairly benign inflation, that input inflation and operating cost inflation has increased at 7% compounded. It is likely, as a consequence of that, that the operating costs which will accrue to a deposit 10 years from now will be at least double, but probably more than double the numbers that are concerned, that are contained in that document, the preliminary economic assessment. So it's important to look at these numbers both in terms of the time value of money, which is to say that you're discounting back to a net present value number. Look in the preliminary economic assessment as to what time value of money assumption was made and employ your own. And it's important, too, to consider much more fully than is usually done the impact of inflation, both inflation in terms of capital cost, which recently has been increasing by 20% per annum, and also in terms of operating cost, which has been increasing at 7% per annum. Finally, Albert, the topic of ESG, each of E, environment, S, social, and G, governance. We touched on this a bit earlier in this interview, but mining companies are forced to, both politically and functionally, to take increasing ownership of the environmental consequence, both real and imagined, of their activity, the social context of their activity, and their own and related governance. To the extent, as an example, that a contractor bribes a local municipality, clearly a governance issue, this is increasingly seen as an issue for the mining company rather than an issue for the host government, because the host government can't or won't do anything about it, and the governors often benefit from it. This is indirect, but it's important to note, Albert, that when you are looking at these documents to get a net present value number, that you begin to analyze and adjust for in your own mind, imprecisely, even improperly, the impact of the increasing role that ESG plays in indirect costs around mining, to understand the impact of inflation, which I would describe as an indirect tax, and finally, again, to understand the role of direct capital stack taxation, be it a carried interest for the government, corporate income tax, payroll tax, health tax, royalties, commodity price increase linked payments. The point of this whole discussion, Albert, is not to tell people precisely how to calculate the impact of tax when doing their investment, but rather to tell them that one of the primary considerations that they need to concern themselves with is tax and the government take, both direct and indirect.
Rick, just a question. Since you bring up inflation, it's clear the concern you have about this being a tax, but I want to know what you think about it in terms of regional stability. If you had an environment where, for instance, the U.S. dollar was firm, meaning low inflation U.S. dollar, giving you some stability in terms of your future costs, but you have local inflation, which, you know, if it's mild, can be seen as an advantage, I guess, because of the wage differential. But that also can introduce instability in the host government. So what are your thoughts on that when inflation gets too severe in the host nation?
That's part of a broader topic, I would suggest, around political and social risk. Very clearly, if you're not just your labor force, but if the regional labor force can't afford to live, right, which is something that I've been confronted with numerous times in my 45 years in mining, global considerations go out the window. If people are desperate, and if people are casting around looking for causes, the fact that you have a very rich neighbor, which is to say a mine, and you are not very rich, particularly if you see that mine supporting the apparatus of the state, but no benefit from the state flows through to you, it will become increasingly difficult to operate. Desperate people, needy people, not necessarily greedy people, but rather desperate and needy people do desperate things. Two, there are functions in society that governments traditionally have fulfilled with the taxes that they've extorted from mining companies. Maintenance of an education system, maintenance of a rudimentary health system, maintenance of a national power grid, maintenance of transportation, maintenance of the rule of law. To the extent that inflationary pressures in host countries means that competing political obligations take a greater priority than the provision of services which might otherwise benefit the mine will be forced either to provide those services themselves or do without the services and see their costs increase. Certainly, as an example, through the Sahel in northern Africa, you're seeing the collapse of the ability of various nation states to defend themselves in terms of security from generally Islamic-based violent political opposition. The failure of the state to provide basic security as a consequence of competing political obligations is another indirect tax, which is to say mining companies are forced to protect themselves because the state, irrespective of the amount that they're able to extort from the mining companies, spends the money in other ways rather than protecting the local communities. This is just one example of the problem that you describe with regards to incipient inflation in emerging markets in particular, impacting the ability of the state to provide the services that they allegedly will provide, and the necessity that the mining companies take these into account and in some measure provide these services for themselves, even on an after-tax basis.
Rick, one of the caveats that you keep mentioning through this entire discussion is nothing is certain. So in terms of what you understand to be the tax policy may not be the tax policy in the future. Are there any red flags that you look for that suggest to you that the agreement that you've been offered is perhaps at greater risk than you're comfortable with?
No, because I'm not that sophisticated, Albert, and I also don't believe that I'm ever going to get it right. I just want to consider it. Most analysis of extractive industry cash flows are done at the project level pre-tax. And I would consider that, while I don't consider a number that I could spend 100 hours coming up with to be an accurate number, I do consider it to be a baseline number. And I don't consider a pre-tax number to be a baseline number at all. Too often, investors, particularly, Albert, investors who come from your background, which is to say an engineering background, think that there's an absolute answer to something. And sadly, there isn't. You are never going to get this right. The idea is that you get it more right than your competitor, and that you get a baseline understanding of what a valuation is so that you can adjust it up or down as circumstances change, because certainly the circumstances will change, and they'll change in ways that you can't forecast.
What I'm getting at here is there is such a thing in life, in work and in play, and people here can probably relate to this, everyone can, as too good to be true. So have you seen some situations like that, too good to be true, as being what should be seen as a red flag in terms of tax regime?
Well, in terms of tax regime, probably not, unless I see an assumption, which I've never seen to my knowledge, the tax rates will decrease.
That would be too good to be true.
Yeah, I haven't ever seen even the most egregious investment bank forecast in securities analysis the tax rates will decrease. If I ever do see that, Albert, we'll do a special issue on that one. I mean, certainly, if we get away from the discussion of tax, I have seen I've seen all kinds of valuation documents use inflation rates, which I considered to be artificially low, or commodity prices that I thought were artificially high or aggressive, or capital cost assumptions that I consider to be unrealistic. But we have dealt with all of those variables in prior interviews. The truth is that government action is difficult to forecast and it's capricious. And I think that while certainly an investor owes it to himself or herself to review the tax assumptions in the assumption part of the valuation document, that unless there is something in the assumptions which suggests that there's a radical departure from the actual contractual fiscal regime, that there isn't anything that I would assume on the face of it to be too good to be true.
Rick, one of the things in the presence of inflation that investors in general are going to have to contend with is, or even wage earners actually, is tax rate creep. Where higher wages or higher earnings as a result of just nominal increases in inflation trigger higher taxes. Is this something that is particularly relevant to resource investors? Because you could be seen as having a windfall profit in a case where the inflation is extreme.
No, I think that's right. I think, unfortunately, you need to assume it, which is to say, if you're operating in let's say, a 25% corporate tax rate regime, that you will have to pay, and particularly if there's a graduated tax, which is to say 25% up to X, 35% over X, understand that the net present value of X falls by inflation, and you fit artificially into a higher tax bracket, irrespective of the purchasing power of the currency units, be they dollars or euros or kwacha, employed. Similarly, as an investor, understand that as a company's earnings increase in a nominal sense, and hence the taxable value of your dividends or distribution occurs in a nominal sense, they may not be increasing in a real sense, which is to say that the after-tax value of your dividend, even in the face of a dividend income increase, may be more nominal than real. What I'm myself concerned in really is the delta between the cost of capital and return on capital employed. And I'm interested in the delta between the expected and real rate of return I get on an investment relative to the rate of return that I would get on other investments. So as an example, if I was looking at BHP or Rio paying 6 or 7% dividend yields, those are relatively attractive to me compared to the 4% return, which I might get on a 10-year treasury. Understanding, Albert, that during a period of 9% compound inflation, the dividend yield I'm getting on a Rio or a BHP is generating a 200 basis point negative real rate of return after inflation. All I can say is that a 2% negative real rate of return is better than a 4% negative real rate of return. So it's important, as you suggest, to understand the impact of taxation, both at the corporate level, but also at the recipient or individual investor level.
Okay, so time is getting short, Rick. Any final thoughts that you want to leave the investor with?
I think what will happen probably is that many investors will sit through the first 5 minutes of this interview and turn it off. But I think 20 or 25% of them will suffer through the whole thing and will ask us questions that will become germane for us to discuss in future interviews. I think we've probably exhausted the topic.
Okay. Well, regardless, 100% of the viewers are going to have to pay tax, Rick. So I hope that more than 25% pay attention till the end. So once again, thank you for this segment, Rick. Very practical insights here. I'm sure the viewers are going to appreciate this. So thank you, and I look forward to next time.
A pleasure. Thank you, Albert.